Hello, this is John Zolaitis. Over the last several years, I've had the pleasure and privilege of giving guest lectures at graduate level securities analysis courses at Columbia Business School. And I'm going to share one of these in a condensed form. While these lectures were intended for MBA students, I think they should be accessible to anyone who is interested in investing. Quovatus Capital is a registered investment advisor in the state of New York. This video is not an advertisement. It's not financial advice. Please contact your advisor. We're going to start with what I'm calling a investing intuition pump. Try to come up with an answer to this question. What do the following four professions share? Just think of one thing, not the thing. The answer that I'm proposing is engineers, firefighters, doctors, and investors are all skilled professions applying a process which they've learned and studied to situations which have different considerations to produce an intended outcome. Now we're going to invert the question. What makes investing different from these three other professions? Try to come up with one thing that makes it different. Well, what I'd like to suggest is that what makes investing different is it admits of a much higher failure rate. The success rate for certain investors that are high quality can be as low as 52 to 58%. And as you know, a doctor with a 55% success rate is something we would call a crook. The premise of my talk is that improving investing results can be achieved not by focusing on being right, but by avoiding areas that are prone to create errors. And so let's talk about where investment errors originate. Investing, I think, can be looked at as a two-component process. So first, you have a decision-making process layered onto securities analysis or equity analysis. And the premise of my talk is that it's not in the securities analysis where the errors most frequently originate, but in the decision-making component. Why would that be the case? Why is it so hard? Well, first of all, Wall Street and the financial media are working against you. Wall Street is a transaction-driven industry. They want you to transact. And the media is a very short-term echo room amplifying whatever emotional content might be occurring at that particular moment. So the two main sources of information that you use when you look at equities and stocks are compromised. Secondly, your time is limited and just focusing is difficult. It's hard to focus. There's tons of distractions, and there's no way you can be an expert in all the companies and industries and whatnot. And importantly, your psychology is working against you. So you want to make actions, but really inaction is the best way to achieve compounding investments. Your brain is trying to tell you that there's information in stock price movements, but most of them are just noise. And we are driven by novelty, but cash flow generation and value creation does not require novelty. So try to answer this question. What do you think is the easiest way to avoid errors in the decision-making process? Make fewer decisions. So if you're going to be wrong a lot as an investor, the best thing you can do is don't make as many decisions. So I'm going to illustrate this idea with a little parable. So for those of you who don't know, Rip Van Winkle is an American story about a gentleman. He goes into the forest. He meets some dwarves. They give him a magical drink, and he falls asleep for 20 years. Versus the busy beaver. The beaver that is very active, doing lots of things. In our version of the story, however, Rip Van Winkle is a portfolio manager. And before he meets the dwarves in the forest, he buys 20 positions and then he falls asleep. After 1 year, with a 60% hit ratio, he ends up with a 4% return. 60% of his positions went up 20%, and the others went down 20%. Amazingly, Busy Beaver gets some capital, don't really know how. He also buys 20 positions, and miraculously, the beaver also gets 60% right. So after 1 year, Rip Van Winkle is asleep and Busy Beaver have the same return. After the second year, however, Rip Van Winkle is still asleep. And let's just imagine that his 60% success rate, those stocks continue to compound at 20%, whereas the loser stocks go down another 20%. And so after 2 years, he's got a 12% return. The beaver, on the other hand, because he's busy, doesn't sleep, and he takes his winnings after the first year and buys another 20 stocks, still gets 60% right, but because he's reallocated the funds to the new positions, the math shows that he's only up 8% after 2 years. So you can see where this is going. After 5 years, Rip Van Winkle, who has done nothing and has just been sleeping, is up 62%, whereas the Busy Beaver, who reallocated his capital each year, is only up 22%. Even though both of these two investors were right 60% of the time, the Beaver ended up with a much lower portfolio balance because he made 80 more decisions. So what I'm trying to get at here is that we frequently hear about the positive impact of compounding, but the inverse is the negative impact of compounding in a high error rate activity. So we want to avoid that. Of course, if you're going to make fewer decisions, what principles can you use to improve your chances that you have a positive group of stocks in your portfolio? So this brings us to my second principle. If you're going to only invest infrequently, you need to focus on stocks that have very high return potential over a very long period. And I'm sharing these 10 characteristics of stocks that could go up 10 times potentially, or 10 bagger, as we might say. So these are 4 criteria that I look for. First, a business that can be much larger than it is today. Second, a business can be more profitable than it is today in the future. But 3, already is profitable. So we're not talking about buying things that are losing money that can become profitable, but something that already has favorable characteristics that we think can scale to even better levels of margins, cash flows, and returns. And then lastly, fourth, something that you can buy at a price that doesn't fully reflect all of these positive characteristics. So you're buying it with a margin of safety. Third investing principle, do not spend any time at all looking at weak business models or high leverage situations. Remember, you're going to be wrong frequently. So what we want to do is improve the probability of being right by eliminating scenarios where your opportunity for gain are limited. So bad businesses, high leverage, low probability situations, not going to lead you to a positive investment outcome. Number 4, I advise do not waste any time at all trying to forecast macroeconomic conditions or the direction of interest rates. Why? Well, experts, I've never seen one that has actually been able to forecast macro, and you are unlikely to be an expert. Secondly, the stock market over short-term periods is not correlated with macro. You can get the macro right if you did get the macro right and still get the stock timing wrong. Third, you will not find great investments through this methodology, and you can literally waste unlimited amount of time reading all the forecasts and macro reports that come out on a weekly basis. And then lastly, avoid speculation. Now, what is speculation? Speculation is when you make an investment or allocate capital to something that has a low probability of success by definition. Here's an example. What do you call something that is loved by many people, has no cash flow, no assets, very limited use, value is determined by auction? Well, I'm thinking of cryptocurrency. I say just avoid it. I would never allocate a single dollar to cryptocurrency. So, summarizing some facts, investing is different from other professions and activities by a high rate of failure. Second, the failures come from is in the decision-making process, I argue, rather than the actual analysis. And three, your time and capital are limited. So the easiest way to reduce investment error is to make fewer investment decisions. Instead, we're going to try to improve the probability and the outcome of the decisions we do make. The first thing to do is look for investments that offer above average long-term potential. That's where you should be focusing your time. Do not waste any time on low return, short-term investment scenarios, trading, things of this nature. Do not waste any time trying to forecast macro or interest rates. You won't be successful, and it won't help you find good investments. And lastly, never commit capital to speculation. If your odds of success when you do all the work are already quite low, why would you deliberately go to a scenario where you already know the probability is lower than average? That's my presentation. Thank you for watching, and please leave any comments below. And you can sign up for my monthly investing letter using this QR code or connect with me on LinkedIn. Appreciate it.